We just have a quick question here from Abu, who wants to ask about breakouts. Abu says that he received a very good explanation about true and false breakouts from Giles, but it seems that I look at breakouts slightly differently and just want some more clarity on this. So thanks for the question, Abu. I think the first thing that I would just say by starting is technical analysis can be a very subjective part of trading, especially in some areas. And there's been many debates about how to interpret and use various technical tools and patterns and indicators. And I'm sure that when it comes to breakouts, it's not going to be any different. So I'm not exactly sure the way that Giles approaches breakouts, and how exactly the way that I look at it differs from him. But I really, really wouldn't make too much of it, to be honest, because as I said, it can be very subjective. And even with things like trend lines and support and resistance areas, even with something like that, there can be many differences between traders. One might use the wicks, and one might use the bodies, and another one might use both. For me, those type of differences are not really helpful, because I don't think there's only just one correct way to look at these types of more subjective tools. So having said that, I'll quickly explain, what I look at when it comes to breaks and false breaks. And again, I'm not saying by any means that this is the correct way. I don't think there's one correct way. That's the way that I prefer to look at things. And there might be many, many traders that look at it differently. As long as it works for you, that's the main point, or the key point to really take away from this. So the way that I normally look at breakouts and false breaks is generally I consider a level to be broken when the market has successfully closed above or closed below a level. And I consider it a false break if we couldn't close above or below it, or we had a close but the next one reverses the move completely. So just a quick example, this one over here, we have this level on the S&P 500 at the 3152. I would consider this candle over here, that for me is a clean break of this area. And this one, we managed to break past it, but we couldn't close below. So for me, that would be more of a false break. But in the same sense, this pattern here for me would also be more of a false break. This one over here. And the reason for that is because we have this level coming up from the high from yesterday. So we closed above that level, but the very next candle actually closed back below that area. So for me, that is also a false break of that level, even though we did close above it. The very next candle actually had a rejection to the downside. So for me, I look at a break. For me, when it's a more convincing break, so apart from just looking at this candle, for example, just looking at the close below the level for me isn't really enough, and I'll explain in a second why. I normally like to see a follow through of the move as well. So a close below or above and a follow through of that move. And the reason for that is because support and resistance areas, they're called areas or zones for a reason, right? It's not just a strict line in the sand. Yes, sometimes the market respects a level to the T, but mostly it's going to be an overall zone where the market reacts from. And that is why I normally like to see the market close below a zone and also follow through to make sure that it's really a clean break of that particular area. Now, the other thing to keep in mind, is that when you use candlesticks, you can look at clean breaks and false breaks and all these things. But the one thing to keep in mind is that there's always going to be differences with one broker to another, right? Because of your liquidity provider. So it's always important to keep in mind that there's lots of caveats and lots of limitations with using things like candlesticks. Yes, they are great for analysis, but they do have lots of limitations. So if you have a broker and I have a broker and they both use different liquidity providers, then your chart might look slightly different from mine. You might have a close on a level, just below a level, just above a level, when my chart doesn't show the same thing. So that's always something to keep in mind. And apart from that, there's always a very big debate, around traders when it comes to the time frame and the closing of candles. Do you use a close of the 5 minute, or do you use the 15, or the M30, or the daily, or the 1 hour? Arguably the most convincing close would be a daily close above or below a level. I think daily closes are more important. But then you have the argument of, okay, if you are using candles, if you are using the daily, are you using a New York candle close daily chart, or are you using another one? So there's so many subjective things out there, so always take these things with a pinch of salt and use it in the way that you feel comfortable with, in the way that it makes sense for you. So that is for regular breakouts and false breaks. But something that I do like, and I probably use this more than any other pattern, isn't just a normal breakout or a false breakout, but something we call a false break pattern. So it's slightly different from just a false break of a level like this one here. It's different from this, and it's actually different from this. A false break is actually this pattern that we have over here. So a false break of a level would be when you have a convincing break, you have a close below it, you're moving through that level, and then you have a very aggressive counter rotation back above or back below the important level. You have a break above, a break back above, a retest, and then a continuation of the move. That is what we call a false break pattern, and that is obviously different from a false break. So you'll often hear me talk about a false break pattern, and that is what I'm talking about. That is normally a break of a level. You have a very successful or convincing break of a particular level. You have a push back above or below that level. If it's a resistance, obviously, you have a push back above, a retest, and that retest of the level is normally your entry signal or your trigger point to take that entry to the upside. We actually had a recent example of this, if I recall, on I think it was the euro pound. Let me just open the euro pound. Yeah, there we go. So we had this pattern a couple of sessions back on the 1st of July, and this is also a false break pattern. So you can see that convincing break above that very important support and resistance area. Obviously resistance, you have a break above that, convincing, and then you have a strong counter rotation back below the level, a retest of the level, and then a continuation to the downside. So that would be a false break on a slightly higher time frame as well. So that is very different from just a false break of a level. So this, for example, this would be a false break of the level, right? This would be a false break of the level, but this entire thing is a false break pattern. So that is obviously slightly different, and that is really something that I can't tell you how many of my entries come from false break entries or false break pattern entries. It's a crazy amount of them. So it's really a favorite pattern that I like to use. But again, it's very subjective. It might work in a certain way for some traders, and it might not work for others. For me, it's a really convincing pattern, and the reason for that is, nothing for me shows the strength of a particular level like when you have a clean breakout, a convincing one, but then the market bids that back up immediately, and you have a retest of that level and a continuation to the downside, or to the upside rather. So when it comes to false break patterns, it really helps to have your levels as accurate as possible. Obviously, we know it's going to be a zone. It's not a to the tick level. It's always going to be a zone. But when it comes to trading something like false break patterns, it'll be good to practice those, spotting those key support and resistance levels on the charts, because they can offer some great trading opportunities if you know what to look for, and obviously if you have your levels marked out correctly. Something that can also work well for false break patterns is your daily pivot levels. The pivots can also be a very great opportunity. So let me just pop on the pivot here and see if I can give us an example. So let's take this recent example, right? So let's say we think that the market is tilted more risk off here. Let me just take this away. Let's say for whatever reason we think the market is tilted more risk off in the session. So here we have this R1 pivot point. We had a clean break above it. We broke back below, and now we can retest that. So this would be a classic false break re-entry pattern to the downside. But obviously you want to be trading in line with a downside bias, which isn't really the case right now in the equity space. But that would be a good example of using it from something like a pivot point as well. So I hope that helps with the question there, Abu. As always, any others, please don't hesitate to let us know.